Has the market finally bottomed? After last week, it sure doesn't seem like it, does it? But I would argue, and I've been saying this since October 13, that yes, the market has bottomed, and we're just going through a multi-month, very frustrating process called backing and filling. That's the short version. If you have time to stick with me for 10 and 15 minutes, let's look at some charts. Let's look at the U.S. one-year Treasury yield. That will provide some insight that perhaps you're not familiar with. Let's look at the VIX. Let's, of course, look at the SP 500, the 500 biggest stocks in America. Let's look at the NASDAQ. Let's look at the Russell. I think that's it. Oh, yeah. Let's look at the Dow as well, and we'll get a really good feel on what's going on in the market. And I think you will be comforted. Things are not nearly as bad as the talking heads would have you believe. So in just a second, let's jump to the charts. The one thing I want to say, well, two things I want to say. One, this is purely for entertainment. This is not investment advice whatsoever. And two, don't forget to check out my Patreon. If you haven't, I show my portfolio and my focus list every weekend. And with that, let's get to the charts. All right, now you guys are probably excited to look at the S&P 500, but let's start here with the one-year U.S. Treasury yield. Simply put, when rates for bonds go up, when bonds are more attractive, then investors put their money increasingly in bonds instead of stocks. So we want to see this line trending down. And as you can see, it's the opposite. It's trending up. So this is the one-year U.S. Treasury yield, and this is the S&P 500. And what Minervini actually, Mark Minervini, two-time U.S. investment champion, just pointed out this weekend that every time this yield curve tries to flatten out and then breaks to the upside, it sparks a new downtrend in the market. So here's a little base. When it breaks out, the market comes down. Here's a little base. When it breaks out, the market comes down. Here's a little base. When it breaks out to the upside, the market comes down. And we just made a really nice extended base. I was hoping that it would break to the downside, but it broke to the upside, and sure enough, the market is trending down again. So Minervini keeps calling this line graph the canary in the coal mine. When this starts trending down again, the market as a whole will probably start trending up again. All right, what's next? Let's look at the VIX. This is the volatility index, the fear index. It's a measure of implied volatility, the amount of volatility that investors expect in the near future. And retail investors and huge mutual funds look at this index when determining how risk averse to be. And the short version is we want it to be down here, below 20. And as you can see, when the market was doing well in 2021, where was the VIX? It was down here, 16, 15, 14. And as the market was crashing, the VIX was way up here in the 30s. So we did get a nice VIX rating in early February, and since then it's spiked up a little bit. We want to see this calm down and get back beneath 20. That's going to encourage small and big investors alike to get their money back in stocks where we want the money to be. All right, let's look at the S&P 500. And before I forget, if you are getting something out of this video, I would appreciate it if you would like the video. So here's the S&P 500. This is the 5-year chart, just to give us a little perspective. Here's the dreaded COVID crash. What a terrible time that was, societally and financially. And what a rip-roaring market we ended up having from March to 2022. Here's our head and shoulders top right at the end of 2021. Here's this ugly bear market that we had. Let's just measure it real quick. Okay, so the S&P 500 came down about 27%, but you know that high growth, low income stocks were down 2 or 3 times that. Some of them came down 90%. So, but just eyeballing this thing, here is our stage 2. I guess this is a crazy stage 1 base. Here's our stage 2 uptrend. Here's our stage 3 top. Here's our stage 4 downtrend. Now here's stage 1, and doggone it if it doesn't look like it is trying to get back into stage 2, right? Now let's zoom in to the 1-year chart. Here's the S&P 500 1-year chart. Here's that lower descending trend line that we saw, and we kept tagging up with it on the way down in 2022. And then we had this huge fundamental shift. We had this huge bullish engulfing day on October 13th across all the indexes, NASDAQ, Russell, New York Stock Exchange, S&P 500, and in my opinion, that marked the bottom. And then what we saw was in just a couple months, 2 or 3 months, the market ran up 20% from the low. And it really feels like it's sold off significantly, but if you measure it, it's only down 6%. So it's still up 14% off the bottom. Now there is, next week is a really important week. It's kind of do or die time. Well, not die time, but it's really set up to get a good bounce. Let me show you why. So the S&P 500 has rolled over and it's bounced off the 200-day. Mutual funds like to buy when it bounces off the 200-day. It is just about to bounce off of this descending trend line of funds, and technicians will see that and be tempted to buy. And after a couple weeks of hard selling, we certainly are oversold, and I anticipate and hope that we will see a nice bounce next week and hopefully a resumption of the uptrend. This little line up here shows the percentage of stocks above their 200-day simple moving averages. That's a good measure of the health of the market. When a stock is above its 200-day, it is said to be in an uptrend. And we are right at about 60% of stocks. So even though it feels like the market is in terrible shape, 60% of stocks in the S&P 500 are in uptrends. Certainly we want this in an easy dollar environment. This is going to be up here at 80 or so. But 60% really is pretty good. And let's look at the NASDAQ chart as well. Here's the 5-year. Same kind of thing. Here's our wild stage 1 base coming out of the COVID crash. Stage 2, stage 3. Gosh, it didn't really make a head and shoulders top. I mean, unless you want to call that a shoulder head and a shoulder, which I guess you could. Here's our neckline. Here's our stage 4, stage 1, and same thing. It looks like it is broken out of stage 1. Now it's just coming back, testing the support line, and in theory, it will curl back up to the upside very soon. Let's zoom into the 1-year chart. There it is, looking very much like the S&P 500. Oh, let's go back. And the NASDAQ crashed 38%, which is really a brutal crash. And as you know, many of the NASDAQ stocks were down more than 2 times that. Going back to the 1-year chart, same kind of thing. We see the price camped out right on the 200-day simple moving average. We see the 50-day coming up to meet it soon. And if we extended this trend line, should we just do that real quick? Why not? It's always kind of fun to draw these lines. As you can see, maybe if there was another down day or two, it would tag up with that line as well. Technicians large and small are watching those as places to buy. So definitely there are fewer stocks in the NASDAQ above their 200-day. So many stocks which are now trying to start new uptrends like, oh gosh, I don't know, Nike, Palantir, etc. Shop, I think SHOP, are still beneath their 200 days. Don't quote me on that. I'm just trying to remember off the top of my head. But only 42% of NASDAQ stocks are above their 200 days. So in terms of that measurement, certainly the NASDAQ has far to go, and it has bled off quite significantly from maybe 55 to 42. Let's jump over and look at the Russell. This is 2,000 smaller stocks, and it has been bottoming for quite some time. Here we see a nice double bottom, another, what do we want to call that? Another wiggle, unless we want to call this a complex head and shoulders pattern. Draw a line across here. It is still in stage 1. Has pulled back the last couple weeks, just like the other indexes, but it is right here about to get support, and we will see what happens with the Russell. Lastly, let's look at the Dow. Now, the Dow is more random than all of them. It's only 30 stocks, but as you can see, same kind of thing. Long downtrend in 2022, quick jump up of 21%. It only has fallen off 6%. We can draw a little support line here, and here's the 200-day about to catch it. So, in conclusion, next week is a really important week. We want to see the indexes get support on these different moving averages and trend lines. Like I said, we want to see the VIX come down. We want to see the U.S. Treasury yield start to come down. And I'm going to just reiterate the same thing I've been saying since mid-October, that unless we see a force majeure, is that how you say it? An act of, a catastrophic act, meaning another epidemic or acceleration of war, or a meteorite wiping half of us out, etc. In my personal opinion, the bottom is certainly in and was stamped in on October 13th here, and now we've run up hard off the lows, and now it's just backing and filling, and then it will soon oscillate again to the upside, break 4,200 here in the S&P 500, and we will be on our way to a new bull market in just a matter of hopefully weeks to maybe a couple months. Now, how can that be when the economy is so terrible and the Fed is continuing to raise rates? Because the market is a forward-looking mechanism. The fund managers fall all over each other trying to get ahead of the game. So all of this bad news gets priced in 6 or 12 months in advance. The fund managers are looking at how economic conditions will be 6 to 12 months from now. And at that time, the Fed will have stopped raising rates. They might even be lowering rates again by then, and the market and the economy is going to be looking pretty good. Those are my thoughts. Let me know where I went wrong, or let me know your personal opinion on any of these things I talked about regarding the indexes, the direction of the market. Be sure to check out my Patreon. If you are not a member, just take a look, and I will see you in my next video. Take care.